Okay, so let's start with our discussion for today. We have the risk and internal control considerations. So our topic outline here is only three. We have the risk versus internal control, risk considerations, internal control considerations. Okay, so let's start with the definition of risk. So risk is a threat that an event, action, or non-action will adversely affect an organization's ability to achieve its business objective and execute its strategy successfully. Risk is also measured in terms of consequences and likelihood. Internal control is a process effected by an entity's board of directors, manager, and other personnel designed to provide reasonable assurance regarding achieving objectives, achieving into three categories, which includes number one, effectiveness and efficiency of operation, reliability of financial reporting, and number three, compliance with applicable laws and regulation. So there are three processes of assessing risk. So we have identifying risk, sourcing risk, and prioritizing risk. So when we say identifying risk, it is a process of determining potential risks to your business. So it can also be called risk identification. This can include anything from a natural disaster that could damage your property to a disgruntled employee who could sabotage your system. So as a business owner, you are constantly faced with this kind of risk. So some are bigger than others, but they all have the potential to impact your bottom line. So that's why it's important to have a system in place of identifying risk. Here are some of the identification tools and techniques to identify risk. First is identification review, brainstorming with the management, interviewing with the employee, using SWOT analysis, using root cause analysis, employee feedback, assumption analysis, and risk register. Okay, and then we have the sourcing risk. Sourcing risk is also known as procurement risk. So this occurs when the process of purchasing or sourcing products, services, or resources become unreliable. So in business, procurement risk needs to be appropriately managed in your supply chain since it can affect the health and revenue of your business. So your business may also face risks associated with the procurement process from a vendor or partner which may be out of their control. So there are 13 common procurement risks. Number one, we have inaccurate internal need analysis. Number two, ineffective supplier and vendor onboarding. Number three, inadequate vendor management. Number four, price instability. Number five, resistance to digitalization leading to poor procurement adoption. And then we have supply chain disruption, manual procurement processes, inaccurate forecasting, compliance management, budget overspend, talent shortage, and inefficient contract management. And then the last process is the prioritizing risk. So risk prioritization is the process used by compliance professionals to analyze risks and determine the order in which they are mitigated. So it is also the process for defining which risks are the highest priority to the business and need to be remediated first. It is also the process of identifying the most critical risks so they can be addressed first. Priorities can be set using the likelihood of a risk and the potential impact it poses to the company. So there are 5 levels of risk prioritization. So number one is we have the tolerable risk or insignificant risk. So these risks have low chance of harm. Number two is low risk or minor risk with a negligible chance of negative consequences. Number three is medium risk or moderate risk. They are those that do not constitute a serious threat but have the potential to cause significant harm. Number 4 is high risk or critical risk. They are those that will surely affect the project's success and have significant adverse repercussion. And number 5, intolerable risk are risks that cause significant system loss that will necessitate terminating procedure, systems, or productivity, which is referred to as catastrophic. So we have 8 different risk considerations. The first one is to evaluate the nature and type of error and omission that could occur or what can go wrong. Number 2 is to consider significant risks that are common in the industry or have been experienced in prior years. Number 4 is information technology. Example is the access, backup, security, and data integrity. Number 4 is other risks extend beyond potential material errors or omission in the financial statement. Number 5 is susceptibility to error or omission as well as manipulation of loss. Number 6 is robustness versus subjectiveness on the process for determining significant estimate. And then we have the extent of change in the business and its expected effect. And the last one is the volume, size, complexity, and homogeneity of the individual transactions processed through a given account or group of accounts. Example here is the revenue and receivable accounts. Management must control identified risks to help the company in order to achieve its performance and profitability targets, prevent loss of resources, ensure reliable financial rerouting, and ensure compliance with laws and regulation. So, noted that internal control can help our company get where it wants to go and avoid pitfalls and surprises along the way. So, we are now under internal control. So, let's start with the fundamental concept of internal control. So, first one is internal control is a process. It means to an end, not an end in itself. Internal control is affected by people. It's not merely policy manual in form, but people on every level of management. Internal control provides only reasonable assurance, not absolute assurance, to an entity's management and board. The reliability and integrity of information, compliance with policies, plan, procedures, laws, and regulation, the safeguarding of assets, the economical and efficient use of resources, and the accomplishment of established objectives and goals for operation and programs are the objectives of internal control. So we also have here the components of internal control structure. We have first the control environment or internal control environment. It more referred to the value that the senior management team of a small business attach the importance of the audit and risk management function of the firm. Number 2 is risk assessment. It determines any situation that may pose legal or financial risk to the firm. Number 3 is control activities, which describe every policy, procedure, and best practice a small business puts into place to minimize the risk. Number 4 is information and communication. They are the method used to train the employee population to control activities. Number 5 is monitoring. It describes the small business practices of self-auditing its risk management system to ensure that all employees are compliant with the internal policies. So that's the end of our lesson 2, risk and internal control considerations. Thank you for listening.